Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today's Analyze Out Loud video is going to be on Magna International, an auto parts and equipment supplier. And this was at the request of a subscriber who also works for the company. And there's a couple of things about this stock when I looked at it that really strike me by looking at the FastGraphs. The first thing I want you to notice is if you look at the long-term history of the company, you can see that price and earnings correlate very nicely. However, I want you to notice the blue line here. This company has historically traded at around a normal PE of 10. That's the value of this PE. Now I'm going to shorten this graph to an 11-year graph, actually to a 10-year graph, which includes a couple of years of forecasting data. I want you to notice we're right at that 9.8. These calculations are always a range. So this is, we'll call it approximately a 10 PE is kind of a normal valuation. The stock currently trades at an 8.1 PE. That's blended PE, which takes into considerations past, current, and the next closest forecast. Stock yields 2.5%. It's a $17 billion market cap. It's A- rated and only has 20% debt to capital, and it's a Canadian-based company. So this is the New York Stock Exchange listing where I'm looking at the company in US dollars rather than Canadian dollars, as you can see here. Now, a couple of things about this. The company's earnings growth, which is the orange line here, but it's also the slope of the blue line, is averaged 14.4%. And that's, very excellent growth. However, it's very clear when I look at it long term, like I did here, which I still have approximately a 10 normal PE, or if I look at it to more recent, the market values this at a discounted valuation, and that is what it is. I don't try to argue with the market there. I'm just fully aware that I'm not going to make my decisions based on a normal 15 PE, which I would actually consider fair value for this company. I would look at it from a standpoint of what the market has historically valued at, and that's about a 9 to 10 PE. So, I would say the stock is moderately undervalued at that level and very attractive on that basis. If I get down to the forecasting calculators, I'm going to start with the estimates calculator, but you can see this puts a normal PE of 15. I'm going to go immediately to the normal multiple calculator, which gives me that 9.7 to 10 PE. Now, I'm going to use the drop down here. I can look at what the company's historical valuation has been, and you can see it's been 9 to 10 historically, a PE somewhere between 9 and 10. So I'll even give it some credit here, and I'm going to go ahead and pick the 4-year normal and put the PE at 10. That would be a normal PE, and then I can run my what-if calculations. Now, when I look at this, there are 15 analysts who are forecasting 14.09% for this fiscal year ending in December. There are 17 analysts, actually a couple of more, who think fiscal 19 is going to be 12.3%. Then it drops down to 9 analysts, but that's still a good group that think it's going to be 9.4. That comes out to an average of 12%. So assuming the company hits these targets, if I look at these normal PEs of 10, we could literally double our money by the end of this calendar year. You could end up with a 100% annualized rate of return. But if I go out here 1 or 2 years, you could average over 34% and see a real nice gain, a 45% capital appreciation gain plus some dividend. And if I go out to 2020, we could see a total annualized rate of return about 23%. This is actually very important. I want to emphasize this a little bit because I find people misunderstand this. When I'm looking at what I might be able to make on a stock, I'm always not just saying I buy it and I hope it goes up. I'm always trying to take the reasonable assumptions, reasonable estimates, reasonable growth expectations, look at a reasonable valuation. As I clearly illustrated a minute ago, this is about a 10 multiple company historically, so I'm going to use that as a logical expectation for the future. That gives me a little bit of PE ratio expansion added to some nice, double-digit growth, and I end up getting a 23 to 24% potential rate of return now for the next couple of years. The key is I have a specific return objective in mind when I buy the stock. Now, I can also look at a longer-term growth rate and get rid of these specific estimates. There's only one analyst producing this, but he's producing, or she is producing, an 11% growth. So, that's an expectation that's about what we see normally. But once again, I'm going to use either this 9 or 10 multiple to give me an expectation of what my growth would be. So now I've got some kind of double-digit expectation for rates of return going forward. I've got very little debt on the company's balance sheet, which I really like. The company gives me a nice 2.5% dividend yield. And if I look at historical performance over this 10 years, this is post-recession, I see an extremely attractive dividend growth rate. I see a payout ratio that's only averaging somewhere in the 20% category, so there's a lot of room for growth there. When I compare it to the S&P 500, however, I see it being about equal, slightly better on a total dividends paid. I see it slightly underperforming the S&P on a capital gain, and I see it slightly underperforming on a total return. However, and I want to really emphasize this, that's based on the fact that this stock is trading at a very, very low PE. If I just put the S&P 500 in here, just to give you a perspective, and I think this is very important when investors are looking at comparing this to the market. If I put the S&P 500 on here, the S&P's PE is more than 19 times what Magna's is. So, we're measuring Magna from a standpoint of a very low valuation, in fact, an undervaluation situation against a market that's overvalued right now. And yet, I still have an investment, even though the valuations are low, is giving me some really good numbers here. So I really like this stock as a potential long-term investment at these levels. I think the low valuation and 8 blended PE against a normal 10 PE makes it very attractive. I like the company's debt. I'm going to go look at a couple of things in the fund graphs real quick. I'm going to go back to this shorter term time frame. I've got revenues per share up here. I want you to notice that revenues per share are growing very, very nicely. We've already looked at some balance sheet items, but you can see the company has very little debt, only 20% debt on the balance sheet. And if I compare that to how much cash they have, the company has about $2 in cash roughly, which is, not great. But the real point is, if I compare that against operating cash flow, if I compare total debt to operating cash flow, let me take revenues off here because it's skewing the graph. Annual operating cash flows are covering the company's debt. So when I'm looking at dividend paying stocks, something that I've talked about in the past, what I will often do is I will look at operating cash flow and free cash flow. You can see the dividends have grown. You can see the dividend payout ratio is very low. So if I draw this on operating cash flow, I'm not really interested so much in how the market's valuing it. So I might take the prices off. What I'm really looking at are the cash flows covering the dividends. And here they're clearly covering the dividends. Now, there are some tariff issues and so on that I think have this stock undervalued right now. Those are something you would want to look at. One of the things that I found interesting is I was asked to do this, and I went and actually got a quote in the Wall Street Journal before I started this video. The stock is actually up 5%, and I haven't seen anything yet that tells me why the market might be reacting so positively today. But nevertheless, there might be something in the tariff discussions. You don't want to do that. If you go into the company's website, which you could do directly from Fast Graphs here, you can see that the company has some very interesting products. They're heavily involved in this powertrain electrification, which is, very, very interesting as far as the greening of America and so on. It's a very good company. It has great fundamentals. It's currently undervalued, and I think it would be something that is worth any of you researching if you're interested in looking for a good dividend growth stock trading at low value. The valuation is low. This is the time to buy it. When you buy the stock like this at a low valuation, I'll do it here where the PE, I'm going to buy it at a PE here that was a little lower than it currently is, about 7, and I get a little bit of PE expansion here, and I get a 14-ish% growth rate, but I get a 21% rate of return. So the time to buy is when the valuation is low. One last thing, by the way, if I click this little split icon here, I want you to notice that this company has split its stock really twice since coming out of the recession. They've had two 2-for-1 splits. So, that's always kind of a good indication. You don't see a lot of splits now. But anyway, this has been Chuck Carnevale saying thanks for watching. If you like this video and are interested in learning more about Fast Graphs, give us a call to the number on the screen or log into www.fastgraphs.com and you can learn more about the Fundamentals Analyzer software tool Fast Graphs. Thanks for listening.